We're here today to take a step back and conduct a structural analysis of the global financial system. Our focus isn't on the daily noise, but on the long-term tectonic shifts in capital. Specifically, we'll be examining the future of the US dollar and China's very deliberate strategic maneuvers. This is about understanding the new geopolitics of capital. When an institution like JPMorgan states that de-dollarization has become a substantive topic, it signals a critical shift. This is no longer a fringe theory discussed on the sidelines. It has moved to the very center of capital market strategy. For those of us allocating capital over generations, this means the underlying assumptions of the last 50 years are now officially being stress tested. So our analysis today will follow a very structured path. We'll begin with the broad geopolitical frame. Then we'll examine a specific thesis for disruption, review the actual infrastructure being built, ground that analysis in hard data, and then conclude with what we see as the primary strategic question for all capital allocators. And just a brief but necessary point before we proceed, this analysis is for strategic modeling purposes only. It does not constitute financial advice. Our objective here is to analyze structural forces to better model a range of potential futures. All right, let's now examine the most, let's say, provocative thesis from our source material. It posits that what we're witnessing is a deliberate, patterned strategy of economic warfare, what some have even termed a controlled demolition of Western financial markets. Now, we're not going to treat this as a prediction, but rather as a model to be tested against the available evidence. So, the data point that demands our attention is this. Over the last 24 months, Chinese entities have reportedly restructured approximately $8 trillion in foreign assets. A capital flow of this magnitude is not noise. It's not a simple portfolio rebalancing. It is a strategic repositioning that requires a much deeper structural explanation. As the saying goes, history doesn't repeat, but it certainly rhymes. And one theory from our sources argues that major power transitions tend to follow this four-stage pattern. Now, the first two stages, interdependency and asymmetric accumulation, well, that's a pretty apt description of the US-China relationship from about 1990 to 2020. The crucial argument now is that China is deep into stage 3, a quiet, systematic build-out of parallel structures to prepare for a potential separation. So this brings us from the historical pattern to the tangible infrastructure. If China truly is in a phase of strategic repositioning, what's the evidence on the ground? Well, this leads us to the concept of the fortress economy. This really represents a fundamental shift in doctrine. For decades, the global consensus, the Davos consensus, prioritized market efficiency above all else. The fortress economy strategy inverts this logic. It explicitly chooses national resilience over maximum efficiency. And that's a clear signal that the strategic calculus has changed to prepare for a much more adversarial world. And here's where the rubber meets the road. This isn't theoretical. We can observe the massive energy stockpiles creating strategic reserves. We see record grain reserves to ensure food security. And, critically for our discussion, we see the construction of a parallel financial architecture and a clear diversification of import dependencies. These are the tangible buffers of the fortress. To really understand the alternative being built, we first have to appreciate the incumbent system. For decades, global payments have relied on this correspondent banking model. Essentially, most international transactions are routed through U.S. banks, which gives the dollar, and by extension U.S. regulators, a central choke point in the global flow of capital. In response, what China is doing is constructing its own rails. Systems like SIPS and mBridge are not designed to replace SWIFT overnight. That's not the point. Their purpose is to create optionality. They provide an alternative path for capital flows that exists outside the direct oversight of the dollar-centric system. This is a core component of achieving financial sovereignty. Okay, so having examined the provocative theses and the infrastructure being built, we now have to act as disciplined analysts and ground this discussion in the data. Is this really a prelude to an imminent revolution, or is it a more gradual, evolutionary shift? The numbers, as they often do, provide a necessary dose of realism. As of 2024, the renminbi's role in the global system remains, well, modest. It accounts for just 2% of international reserves and less than 5% of SWIFT payments. Meanwhile, the dollar's incumbency, at nearly 60% of reserves, is deeply entrenched. The network effects are powerful. A revolution is simply not reflected in this data. So the crucial point here is that we're not witnessing the dollar's replacement, but rather its gradual marginalization in specific trade corridors. Think Russia-China trade settled in local currencies, for example. This is about financial diversification, not a sudden collapse. The dollar's grip is loosening, one bilateral agreement at a time, but it is certainly not broken. So, to model the suture, we can use this framework, which is exceptionally useful. It moves us beyond a single binary prediction and toward a range of outcomes based on two key variables: China's own domestic policies and the external geopolitical environment. And briefly, these scenarios range from a rapid rise in a friendly world to a reactive great leap that's driven by conflict. However, the scenario that most closely aligns with the fortress economy evidence we've just reviewed is the safety net. This describes a conservative domestic policy with an adversarial environment, where the primary goal isn't global dominance, but simply ensuring the security and viability of international payments during a crisis. Which brings us to our synthesis. We've moved from a historical pattern of disruption to the physical reality of the fortress economy and laid it on the data-driven view of a gradual evolution. The clear trajectory, then, is toward a more fragmented, multipolar financial world. And this presents a fundamental choice for capital. And this, really, is the ultimate question for us as capital allocators. For the last 40 years, capital has flowed almost frictionlessly across borders, always in search of maximum efficiency and the highest return. But in a fragmenting world with parallel systems, does that logic still hold? Or will capital be forced to retreat into geopolitical blocks, prioritizing security and resilience over pure efficiency? That is the structural shift we must all now prepare for.